Good morning. Welcome to this market update for the 3rd of December. The last week is very interesting because we may be seeing a change in the leadership. Technology stocks in America have been the undisputed leader of the market for the last 2 years. And whilst I'm not expecting anything dramatic to the downside, it does look as though money is rotating away from technology and through profit taking and moving into other sectors. So perhaps some significant market changes, and how the next couple of weeks plays out will give us a much stronger fix on what the medium to longer term will look like for the market. So let's take a look at what's in this particular update. So I'm just going to have a look at the sector rotation that's underway, see where the money is flowing to now. And the normal stock and commodity trend update as per each week. Now, last week in Portfolio Analyst, there were 3 new strong buys, and they've gone on and done well during the week. So hopefully, people that are in Portfolio Analyst were able to benefit from that. So looking at American stocks, the S&P index was higher by 1.5% on the week, and there was certainly some evidence of climactic action in tech stocks and a sudden downturn. Now there was a bit of a bounce back on Friday, but that's not unusual. That often happens. So we need to see a bit more action to really determine how this is going to play out. But certainly there's no question that there was a buying surge on substantial volume, and then that really marked what I expect will be a peak in tech stocks for a number of weeks and possibly a number of months. But as I said, we need another week or two to see how it reacts, see what the volumes are like to the upside and the downside to really determine that. The S&P surged and held well above 2,600 points. It was a big week. 1.5% for the S&P is a big week. And really importantly, the market breadth is continuing to expand, and expanded quite rapidly in the last 2 weeks. If you look at the number of stocks trading above their 50-day moving average, it increased from something like 55% to about 75%. That's a huge advance, and we can see that in the Russell 2000. So very, very positive. Is some consolidation due? Look, it is. There's no question about it. When we look at the charts, you'll see just how far the indices have got above their 50-day moving averages, and even in some cases their 20-day moving averages. So I think there's got to be a case to see some consolidation for maybe this week. Maybe the next week or 10 days we get a bit of consolidation, and then we get the normal run into the end of the year. But there's a lot of contrarian signals that are sort of building up at the moment. If you look at the put and call ratio in the options market, it's indicating that there's a lot of complacency. People aren't buying put insurance. They're not fearful of the downside, and generally you often get a short-term correction in the market when you reach that point. Interestingly, consumer discretionary stocks in America have taken over leadership along with others. Financials have done well. A number of industrial groups have done really well. But when you've got the Russell 2000 running as hard as it is, and you've got consumer discretionary stocks running like it is, that's indicating a very healthy economy and an enormous amount of confidence in what's going on over there. So it's really hard not to be bullish about the American market over any time frame. Now the US dollar varied a bit during the week, but net was pretty much unchanged, and I guess the currency market is really just waiting on the December rate hike decision, but I think it'll be a big surprise to everybody if the Fed doesn't raise interest rates. So let's take a look at some charts. We'll start with the S&P, and you can see on Thursday we actually hit an intraday high of 26.57, and the price had got well above the blue 50-day moving average line. it just begged a bit of profit taking. I think any old reason would have done, but the issue of Trump and the Russia investigation, that just provided the trigger that the market was looking for to take some profit. But what you'll notice is that despite a significant intraday dip, where the S&P actually got down to a low of 2605, so that's a 50-point range on the day. That's a big day down or big range on Friday. But you'll notice that the buying obviously stepped in because it basically closed where it opened, which was down just a fraction on the previous day. So clearly there are buyers in the market, but look, it's still well extended above the mean. The RSI is well and truly overbought. I really think that we may get a consolidation. In fact, I kind of hope we do, because when the market, so if we got a consolidation like that, perhaps even maybe a little bit deeper consolidation like this over the next 7 to 10 days, and then that sets up for a nice run into Christmas, and we ended up with new highs. I think that would actually be a really good thing for the market. If it just continues to advance from here, then ultimately the trigger that causes the market to come down will be that much more severe. So that's kind of what I'm hoping for at the moment. Now let's look at the NASDAQ. So we'll look at the QQQ, and you don't see a lot of, it's certainly off a bit more. You see the significant selling on Wednesday, and look at the volume around that selling on Wednesday. That was quite a sharp move for the NASDAQ, but then that includes technology, but it also includes a lot of biopharmaceutical stocks, a lot of other higher volatility stocks. It's when you zoom in a little closer, which I'll do in a minute, that you see more the technology and particularly semiconductor stocks. Let's just look at the Russell first. So this is the Russell. You can see it also experienced a fair amount of selling, but basically it had set new all-time highs and quite robustly so. Definitely outperforming the S&P in the short term. A big range on Friday, but again, the buyers stepped in very willingly. So the Russell 2000 together with the market breadth is sending us a very, very positive signal. Now let's just zero in a little bit, look at technology. So there's the sell-off in technology on Wednesday and the high volume associated with it. I think there is close to 100% probability that this is stopping action. This is as far as the advance is going to go for now. Now, whether that now is weeks or months, we don't know. But when you get a reversal like that from well above the mean, and it happens on a huge increase in volume, that volume is triple to 4 times what we've seen through here, then this is stopping action. I think this trend is now finished for a little while, but I'm not expecting a lot of downside. I think what we're likely to see is something like this. But look, this time next week, or perhaps the week after, I'll be a lot clearer on how that's going to play out. Now, just zeroing in a little bit further, so this is the semiconductor sector industry group within technology sector, and this has been the clear leader. If you look at the trend, it's been enormous. It broke out of consolidation in June of 2016. So it's been running very hard now for 18 months. It was $56 back then. We hit a high of 105, so it almost doubled in 18 months. So clearly just about the strongest industry group on the US market. And that was a bigger sell-off on Wednesday and didn't recover as much as the rest of technology. So the same thing applies here. It's not all over for semiconductors long term. This is a consolidation period, and just again the next week or so will tell us how that's likely to be. Just turning to the US dollar. So not a lot of change. Was up early in the week, gave those gains back, and net didn't move. And while I'm here, let's look at the Australian dollar. Pretty similar. We were down very slightly, 0.1 of a cent, but we're clearly back in the trading range, well and truly back in the trading range. And there's a lot of fundamental evidence and reasons why the Australian dollar is heading for 60 cents. Now, that's not going to happen overnight, but that's what the fundamentals would indicate. However, those fundamentals have been indicating that for quite some time, and that didn't stop the Australian dollar spiking to 81. So when it comes to the currency market, who knows? But I think the long-term trend, most economists would indicate that significantly lower than where we are is likely. And therefore, if you've got money invested in the US, then the chances are you're going to get a huge boost on top of any profits that you make just through the currency effect. Turning now to Aussie stocks, the Aussie dollar was down 76.1. There's the support levels that I gave you last week. Our index managed to gain slightly on the week. It was up 8, but again, couldn't hold above 6,000 points. Had a look above it, but couldn't hold it. And the winners on the week were energy and small caps. They were definitely the strongest parts of our market. So let's take a look at that. So we'll look first of all at small caps. So they've continued to blast ahead. They were 2,400 at the start of September. Now they're at 2,700, and that's really the place to be in the Australian market, no question. The strongest part of the week was energy, in keeping with what we were seeing overseas, but finance was down a little bit, materials were down a little bit, and that resulted in the ASX 200 really just going sideways and unable to sustain above 6,000 points. So that's been the case for 2 weeks in a row. Also, too, the other chart I just want to look at, I mentioned the junk bond market a few weeks ago and how important it was to watch that. This is the junk bond ETF on a weekly chart. You can see it hasn't broken down. It certainly gave some signs of breaking down here 4 weeks ago, but it's managed to bounce. And at this point in time, it looks okay. Precious metals, gold was down $8 down to $12.81, and the environment for gold rising is just not there. There's just no reason for gold to go up at the moment. It needs a crisis of some sort to really propel gold higher. And as a result, the precious metals indices were lower, but there were some gainers. And I've made mention on numerous occasions that Northern Star in Australia is unquestionably our best gold stock and perhaps the best gold stock in the world, and certainly the price chart would support that. Copper fell to $3.08, and crude oil was also down a handful of cents. But the sector is looking much better. The oil services group was up 4.6 on the week. Integrated oil and gas stocks, so they're the big guys, up 2.5, and also exploration production stocks were up to just under 2.5% as well. So certainly seeing some good signs in crude oil. Let me just take a look at gold. So there's precious metals on a daily chart, just eased down. Most of that was given up on Wednesday. And if we go to GDX on a weekly chart, you can see there's been no change here now for a long period of time. You've really got to go back to October of 2016 when the GDX was higher. So not much happening in that space at the moment. There's the spot copper chart. So just to wrap up, markets are certainly getting a bit overheated. I would like to see some sort of consolidation before we run into Christmas. I think that'd be good. That'd be healthy. The process that I use and what I'd advocate all traders and investors use is to identify the leading industry groups and then identify the leading stocks within those groups. And I've been touching on that. In fact, I did it to a fair degree in Portfolio Analyst last week. Went through the process that I follow to generate my watch lists, which are very extensive. So identify the leading industry groups, then the leading stocks, and then buy the dips. And there's a rationale for that, which I've explained in Portfolio Analyst, and that is that fund managers have to be in the outperformers. They can't afford not to be. And so if we're not in the outperforming sectors, which then become a self-propelling mechanism, then we're just not in the most productive parts of the market, and that's just the reality of how markets work. Now, Portfolio Analyst this week, I'm going to be having an extensive look at the leading sectors and industry groups, and I think you'll find that fascinating. So for those who aren't members of Portfolio Analyst, there is a free trial available that you can utilize, and I think you'll get a lot out of it. And certainly this week, it's going to lay out the game plan for how you determine where the money's being made. Where are the institutions putting their money? And when they start putting their money into a different sector of the market, they're so big and there's so much money involved, they can't do it in a very short window of opportunity. That process takes weeks and months to build, and then is generally sustained for a lengthy period of time, sometimes years. So it's really important to understand the process of how the market rotates money from sector to sector. There's my contact details for anyone that wishes to communicate with me who's not a member. And I think we've got yet another fascinating week ahead of us, and I'll be back with you then. Cheers.